Welcome back to Options Guide, where we break down option strategies that work in the real world. I'm your host, and today we're talking LEAPS. If you're tired of locking up huge amounts of money in individual stocks, or if you've wanted to diversify without needing a six-figure account, this might be your new favorite tool. Let's explore how LEAPS can help you grow wealth with less capital and smarter strategy. What are LEAPS and why they matter? LEAPS stands for Long-Term Equity Anticipation Securities. It's a fancy name for options with expiration dates at least 1 year out, typically 12 to 39 months. Think of it like this. A regular option is like renting an apartment month to month. LEAPS are like signing a multi-year lease. You've got time for your investment thesis to play out. Let's break it down with an example. Apple stock is trading at $180. 100 shares equals $18,000. Or you could buy a LEAPS call option with a $180 strike expiring January 2027 for about $25 per share, or $2,500 total for the 100-share contract. So instead of dropping $18,000, you control the same exposure for just $2,500. That's just 14% of the capital. If Apple goes up to $220 over the next 2 years, both your stock and LEAPS could make around $4,000 in gains, but with LEAPS, you only risk $2,500. And here's the kicker. With that remaining $15,500, you could buy LEAPS on 6 or 7 more stocks, diversifying your portfolio for what would normally cost over $100,000. LEAPS versus stock ownership. Stock ownership advantages. You get dividends, no expiration. You can hold forever. You own part of the company, no time decay. You get voting rights. LEAPS advantages. Massive capital efficiency. Limited downside, you can only lose what you paid. Higher percentage returns. Diversification across more stocks. Built-in stop loss. Your premium is your max loss. Let's compare 2 investors, each with $50,000. Investor A, stock buyer, buys 278 shares of Apple at $180, which equals $50,000. If Apple hits $220, they make $11,120, a 22.2% return. Investor B, LEAPS buyer, buys 20 LEAPS contracts at $2,500 each. That controls 2,000 shares across Apple, Microsoft, Google, Tesla, and Amazon. If they all go up 22%, he makes about $22,000, a 44% return. Risks. Investor A puts all their money in one stock. Investor B diversifies. Dividend trade-off. Investor A gets about $278 in dividends from Apple, $1 per share annually. But LEAPS investors usually earn more from capital appreciation. When to choose stocks instead of LEAPS? You want dividend income. You're investing for retirement. You want long-term ownership. You're focused on high-dividend stocks. 3 best LEAPS strategies. Stock replacement strategy. Instead of spending $20,000 on Microsoft stock, spend $3,000 on Microsoft LEAPS and use the other $17,000 to diversify. You get similar upside with less capital at risk. Best for long-term investors who want more positions with less cash. LEAPS covered call strategy. Buy a deep-in-the-money LEAPS call, like $150 strike, and sell monthly calls like $185 strike. Cost, $3,500. Income, $250 a month equals 7.1% monthly yield versus just 1.4% if you own the stock outright. Best for income-focused investors looking to generate cash flow. Sector rotation strategy. Want to bet on hot sectors like AI or clean energy? Use LEAPS. Instead of putting $60,000 into AI stocks, put $10,000 into LEAPS on NVIDIA, AMD, and Microsoft. Your upside is still large, but your risk is far lower. Best for investors with strong convictions in specific themes. How to choose the right LEAPS. Time to expiration, go for 24+ months if possible. Delta, sensitivity. Stock replacement, 70% to 90%. Aggressive plays, 50% to 70%. Liquidity filters. Bid-ask spread less than 5%. Open interest greater than 100. Daily volume greater than 10. Stick to large cap stocks. Strike price strategy. Conservative, 10 to 20% in the money. Moderate, at the money. Aggressive, 10 to 20% out of the money. Only use LEAPS on quality stocks. Strong fundamentals. Solid balance sheet. Market leaders. Clear growth narrative. Avoid LEAPS on penny stocks. Highly volatile biotech. Poor fundamentals. Dying industries. Risk and taxes. Key risks. Time decay. LEAPS lose value slowly, faster in the final 6 months. Volatility drops. Lower implied volatility can hurt your position. No dividends. You don't receive payouts from the stock. Risk management tips. Limit each LEAPS position to 5 to 10% of your portfolio. Take profits at 100 to 200% gains. Cut losses at 50%. Roll options out 6 to 9 months before expiration. Tax notes. LEAPS equal capital assets. Hold more than 1 year, taxed at long-term rates, 15 to 20%. Index options like SPY and QQQ equal special 60 to 40 tax treatment. No dividend taxes. Watch out for wash sale rules. Avoid buying and selling the same LEAPS within 30 days. LEAPS are a powerful tool for long-term investors. You control large positions with less capital, diversify smarter, and reduce your risk. But they're not for everyone. You need to pick high-quality stocks, give them time, and manage risk carefully. If this breakdown helped you out, smash that like button and subscribe for more no BS investing strategies. Drop your questions in the comments. What stocks are you considering for LEAPS?